You're listening to The Weekly Edge, your straight-talking guide from industry experts on what's really moving the fixed income markets, here in Australia and around the globe. Brought to you by Gilt Investments. The Weekly Edge is your go-to podcast for sharp, actionable insights into the forces driving bond markets. Each week, your hosts Alistair Healy and Richard Brennan take you on a fun and insightful romp through the financial markets. With their no-nonsense style and deep experience, they help you cut through the noise. Alistair's deep market smarts and Rich's trend-driven mindset make for the kind of conversation that keeps investors sharp, and always one step ahead. Quick hits, smart takes, real perspective. Let's dive in.
G'day, and welcome to the Weekly Edge. It's Thursday, the 17th of April, and you've been watching markets lately. Yep. We feel it too. A bit of whiplash, a bit of deja vu, and a whole lot of what on earth is going on. Al's here with me as always, our resident bond whisperer, and the man with a caffeine habit directly linked to central bank commentary. Al, welcome back. I've got to ask, how many rate cut headlines does it take to make a man doubt reality?
Yeah, g'day, Richo. Well, I guess that's the big question, isn't it? I know the market is saying that there's going to be rate cuts, but at the end of the day, inflation is still a massive issue around the world. They haven't solved it yet. They've slowed it down by pushing rates up, but they haven't solved it. So for me, to talk about rate cuts right now, it's probably a little bit premature everywhere, particularly when you've got someone like Trump who's going to put tariffs on everything, as we've seen already. So I can't see it. I think we're going to end up with issues that are we haven't seen for a while. I guess like stagflation is suddenly now being talked about. So that's probably going to come through more than anything than rate cuts. So I think rate cuts is really way too early, and I think it's really people with conflicts of interest are saying rate cuts more than anything.
It's been a wild week.
It's been a massively wild week. In my working life, I don't think I've ever seen it like this, ever. To swing around 1,000 to 2,000 points has really turned the world upside down. I don't think we've ever had the situation where, in my working life for sure, we've never had a prime minister or a president or anyone in any country to come out and just whack 145% tariffs on a country. So where that's going to take anybody, take any market is anyone's guess. I don't think anyone knows.
Tariffs flying, inflation sticking, and everyone, even from Ray Dalio to Elon Musk, chiming in.
Yeah, because of the confusion that's in the market. Most of these people like Ray Dalio have spent their life researching things and having a look at historical trends and stuff like that, and then putting in strategies within their portfolios to take advantage of it. But I don't think there's been a time that I'm aware of that we've got this situation where tariffs have been whacked on so heavily, and you're now getting a trade war. I don't think anyone has been through this. So people like Ray Dalio and portfolio managers and, the whole lot are now trying to reassess, because we're going from an environment that was, you had free trade zones to now trade war with tariffs. So, what the final outcome's going to be is anyone's guess, I'd say, even people like Ray Dalio.
Today, we're going to dive into this global trade mess, stagflation creeping back into the narrative, and what it all means for Aussie fixed income. So, buckle in, folks. This week's Edge might have a few sharp turns. So let's start with the global trade war chaos, Al. Let's get into the big headline. Trump's gone full trade warrior again. Tariffs flying in every direction. Now 145% on Chinese goods. I believe it's even lifted up overnight. Europe copying it. Canada trying to negotiate its way out. It's like 2018 called and wants its headlines back.
Yeah, it's, that it certainly has thrown a spanner in the works globally. We've never had this sort of situation again, as I've said earlier on. And you put that in an environment where most countries globally have got way too much debt. So, we're now going to be faced with a situation, which is why the terminal, why stagflation is now being talked about, because you're going to have inflation going up. If you put the prices of products up in America in particular, which is the biggest consuming economy in the world. So you start putting tariffs on all their products. Initially, they're not going to stop buying. They're going to continue to buy until they realise that it's way too expensive and their life's been squeezed. So they'll have to back off because they can no longer afford things because the prices have gone up. Well, that's going to be inflationary for sure in an environment where interest rates are really high. So if you interest rates are really high, the debt levels per country are really high. So if you have an inflationary environment, normally that means the Fed's going to push rates up to control inflation. In an environment where, you know, countries have got heaps of debt. So that's why stagflation is now starting to be talked about, because you're going to have a high inflation environment and you're going to have an economy slowing down because we've got way too much debt and interest rates are going up.
Interesting, you know, we've got all of this turmoil, but now we're getting a bond market tantrum. Treasuries got dumped, yields spiked, and the so-called safe haven turned into the problem child. And that's the kicker, right? So treasuries are usually where everyone hides in a crisis, but now they're part of the crisis. Some are even saying we've hit that tipping point where the sheer size of US debt is starting to scare people.
Yeah, I don't, you know, I guess I always balk a little bit when people start talking about the normal way things are going to react. For me, I think the reaction by the bond market is actually spot on. If you're in an environment where you've got way too much debt and inflation is going to come along, then it's going to make it hard for all countries, to be able to service that debt. So in that environment, really, the risk has gone up. You look at Australia, for example. If we head towards a recession when we've got the amount of debt that we've got, and the same as the Americans, if you've got a lot of debt and you struggle to pay off that debt, then that really means the risk has gone up. So if the risk has gone up, then you really should be paying more for your money, because we operate in a risk-reward environment. So for me, the fact that the stock market, the bond market started to sell off at the same time the equity market was selling off was because they're worried about the fact that tariffs are going to be put on everything, and it's going to make it really hard. If the economy heads towards a recession, it's going to be really hard for governments to start paying down their debt or getting their budgets back in order. So that means the risk has gone up. So hence the market sold off in the bond markets. And you're right, we haven't had that environment before. It's always been, if the stock market sells off, people put their money into fixed income, brings the yields down and the price up in the fixed income. So they get compensated by the capital gain on their bonds that alleviates some of the pain on the equity markets. But this time around, as we said, we're going from a different environment, which is, you know, free open trade zones, to now tariffs. So that's why the market's reacting differently. I don't think the market, to me, is working properly.
Yeah.
This is how it should be.
It's just that the old 60-40 model, 60 in equity, 40 in bonds, no longer offers the comfort it used to offer.
Yeah, definitely. Everyone's going to have to rethink how they manage their portfolios and manage everything, because we're now going to go into probably a high tariff, trade war, inflationary sort of environment. So that'll turn the whole world upside down.
So let's look at China. So they're not exactly sitting still in all this turmoil. They're retaliating with massive tariffs, pumping credit into their economy, and doing what they do best, trying to look calm while subtly shifting the board. Rumour has it they're also letting the yuan weaken and telling banks to soak up the dollars.
For me, China is a novice at all this. If you go back, it wasn't long ago, they were basically farmers. And if you looked at the newsletter, my chart newsletter today, there's a great chart there that shows, you know, it was only about 20 years ago where China was really just a very small economy, and now they're the second biggest economy. In that environment, you know, they didn't have pots of money saved away, so they've borrowed all the money. So they're now in an environment where their property values have dropped. They've got huge amounts of debt. They are basically a manufacturing export powerhouse because they've, you know, in essence, taken everyone's manufacturing. So if the biggest consuming economy in the world starts putting tariffs on all the stuff that they buy from China, that's going to put them right on the edge. So they have to react, but I don't think they know how to react. in this environment. So they're struggling, they're scrambling.
What's your gut feel here? Now, I believe overnight it's now up to 245% tariff now from Trump. Yeah. So my gut feel is, why don't they just call it out as it is and stop any trade with China?
Yeah, well, both. You'll have both, I guess. You'll have the Americans. Who knows what's going to happen on the American side and how high these tariffs are going to go. That's up to them and the lap of the gods a bit. And then, I guess Chinese culture is that it's all about face and looking good, so they don't really want to let on that they're doing it tough, or they might be doing it tough, or this is going to cause a lot of grief to their export side. So both sides are going to, I guess, headbutt, and hence we're going to have this war, and it's probably not going to end well.
The massive poker game, who blinks first?
Yes, absolutely. Who needs who first?
Let's move on to Japan. That's always interesting from Australia's perspective. They're not getting involved. They're saying, thank you very much. They're saying, we're allies, they said. We won't touch treasuries. What that means in translation is, we've got enough problems of our own. Is that what they're saying?
Yeah, definitely. Japan's always been a bit of a sleeper. They're a big economy. They're a great economy. They're big manufacturers as well, but they've also got a lot of debt. They've got excess income. They've got money invested in America at the moment, so they're sitting on treasuries, but they've also got a lot of debt. I've read articles that have suggested if they move their debt in Japan is funded locally, so when they sell Japanese bonds, they sell them to local investors. So the debt has been self-funded, if you like. But those people who are buying the bonds in Japan are the older set, and Japan's economy is now sort of starting to get old and retire, and I guess the population's shrinking. That end of the population are the ones holding all the bonds. So they've got a massive issue as if all the elderly people in Japan want their money because they're all retiring and they want to enjoy their retirement, they're going to have to sell the bonds, which means the Japanese who've got this money sitting in America probably have to sell the US dollars, bring it back to Japan to pay out all the JGBs because of everyone retiring. On top of that, you've got a population that's shrinking, so some of that will go to the young people who will then probably sell it anyway. So the issue with Japan for me is if they go offshore, when they're funding it locally, if you look at their interest rates, their 10-year bonds are really, really low, sub 1% sort of stuff. So they can fund a huge debt to GDP type figure of 250% locally because the rates are really low. But if they are forced to go offshore to fund their issuing program locally, then they'd have to pay about 2%. If rates are going up even more so, in the States, it's going to make it even more expensive if Japan has to go overseas to refund all the bonds that are being sold in Japan.
So let's bring it back to Australia. So Al, what's the actual impact? How do all these big moves across the Pacific start to ripple into the Australian fixed income portfolio?
Yeah, for me, unfortunately, every country, including Australia, have made themselves vulnerable we've all copied each other when it comes to stimulating our economy. If you go back to 2008, when the market corrected in 2008, and then it was led into the COVID era where everyone went through the same process. We all went through the quantitative easing. We all went through the quantitative tightening. We've all sort of stimulated our economy using the retail residential property market. So we're identical. And as a result of that, Australia's got nearly $1 trillion worth of debt. We've also got another $700 billion at state level, and household debt in Australia is up there with the best globally. So, and we've got a floating currency. So we are absolutely exposed to the global markets, whether we like it or not. The $1 trillion worth of debt that we've got, the best article I've read has said that about 40% of that has been borrowed from overseas. So if rates get really high or people overseas need their money back, that's definitely going to come across to us. It's only a case of when and how we will react to it.
So to put it plainly, investors should be watching the US-China headlines, not just for the drama, but because it literally moves Australian bond prices?
Yeah, absolutely. if you do nothing else, just be cautious for the next 12 months, because we don't know how the world has just been turned upside down. Trump is not going to back off. He's going to put tariffs on everything, and he has already, and he's going to play games. That's not good for anybody. Companies have to reassess. They have to, work out how they're going to make a living. It doesn't take much to read to see that already companies are starting to fall over because they're been manufacturing everything in China and selling in America, and those types of businesses are going to disappear. Then you've got local businesses that are going to potentially have the advantage where imports are going to be higher, and they can start undercutting those import prices by manufacturing locally. So all of that's got to play out. So for me, as we said last week, you don't know where the risk is. You've really got to keep an eye on the market. You've got to bunker down, I would say. So, government bonds, things like that, just within your parameters of risk. Some people are quite happy and can sleep at night taking huge risks. Well, it's your call as to how much risk you want to take. But in the next 12 months, you've got to keep an eye on it. You've got to read as much as you can and try and get a lay of the land where that risk is going to pop up. And is that risk you're comfortable with or not? If it's not, then you need to back off.
Wise advice. So let's talk about this ugly word that's now sneaking back into the conversation, stagflation. So that's the uncomfortable combination of both rising prices but slowing growth. So it sounds like a hangover that won't go away. Is that right, Al?
Yeah, it doesn't take much to understand what sort of environment that's going to be for anybody. Wages generally, as a rule, everywhere haven't really gone up as much as they probably should have, I guess. If you've got inflation, that's going to push the prices up everywhere. And I think people are feeling it right now. If you buy the groceries for any household in Australia right now, you'd be feeling it. So people know that prices are going to go up, and that's going to continue to go up at a time when there's no growth. No growth normally means that companies struggle to increase their revenue or even just to make revenue. People start to become unemployed. If you lose your job and you can't pay your mortgage and rates are going up, standard of living is dropping in a stagflation environment, and that's not good for anybody. And
so that what you're saying is a polite way of saying brace yourselves. That's what you're saying.
Yeah, bunker down, brace yourself, and get ready, because it could. If I'm wrong and it doesn't go that way, fantastic. But right now, all the signs are saying it's going to be pretty tough.
So, Al, part of these signs, we're seeing bond yields not fall, even with recession risk rising.
Yeah. So going back to my analogy about risk reward, well, the whole financial markets, particularly bonds and the equity, the fixed income markets, based on risk reward. The higher the risk, the greater the reward. So the higher the risk, the more you need to pay for your rate, for your borrowings and your money. So if Australia has got a lot of debt, and it has, and even on the revenue side, we've got some industries that are doing it tough. There's really only five industries where we make money: education, construction, tourism, farming, and mining. Education, construction, and tourism basically aren't where they used to be, so they're down. Farming is probably still there, but depending on what the weather does. And then mining, we're doing our damnedest to sort of give our mining industry a hard time. So that means our revenue's dropping away whilst our debt levels are quite high.
So everywhere we look, there's signs of softening, not just in Australia. We've got the US, also Canada's housing market is cooling. UK's job data is flatlined. Chinese coal imports are down. It's everywhere, isn't it?
Yeah, it is. Absolutely. And as I said earlier on, we've all got the same problems, which means you don't have any corresponding sort of benefits. Everyone's going to be trying to do exactly the same thing because they've all got exactly the same problems. So that's why you're going to have and then tariff wars thrown on top of that. And then you're going to have everybody's going to want their currency to go down, but not everyone can. So that's where the difficulty is going to be. And money is like water. It finds its own level. It will go where the risks are, where the better returns are based on the risk that fund managers are happy with. So you'll get this wad of money washing around the world, which will swing currencies all over the place and swing interest rates everywhere because everyone's going to be vying for it or trying to push it away.
So this is going to throw a spanner in the works towards the traditional portfolio. So that's in the sort of the realm of the theoretical ideal world. Now we're in the real world, this very messy one. So that's going to put a lot of different sort of frame of reference on the portfolio manager, isn't it, as far as how you tax it?
Absolutely. As we said earlier on, the world has just changed. We've gone from a free, open, free trade zone sort of environment where, everyone sort of seemed to work together to now a tariff war environment. So that's going to turn it upside down. So you have to, if you don't take notice of that and adjust and be ready for it, then you're asking for trouble. You definitely portfolio strategies, just personal home strategies, things like that are all going to have to be different in the new era or the new environment of trade wars.
So let's bring it back to the home turf. Amidst all this global chaos, the Aussie bond market. It has been relatively pretty steady, but there is a storm cloud or two brewing.
Yeah, definitely. As I said, we've got way too much debt, and a fair chunk of that is borrowed from overseas. Or in other words, overseas investors have come in and bought our bonds. If they want that money back, that's going to put pressure on the Aussie dollars. So we're sitting and waiting. We're a small economy in the global scheme of things, so we're not high on the radar for most people. The bigger markets like Europeans and UK and Japan and America are more on the radar for the fund managers, and we sit under the radar a little bit, but ultimately it will hit us. And this could be related to whatever happens. If we keep our AAA rating, then that's all good. We might not get hit as hard, but if anything changes, then we could get hit pretty hard.
Interestingly, we've got jobs data due this week, and the last print had a shocker drop of over 50,000 jobs and unemployment nudging up to 4.1%, which I know Albanese was quite proud of last night on the television. But that doesn't exactly scream strength to me.
No, not yet. I think it's still early days would be my take on most of it. We haven't really felt any pain yet. If unemployment just sneaks up a little bit, it's not a trend yet, I guess. So we would wait. The Reserve Bank's going to sit and wait for sure. I don't think they're going to move things too much. So I think basically everyone's sort of, noticing what's going on overseas and sitting and waiting. They'll keep an eye on those figures. If they start blowing out really badly, then the Reserve Bank will manoeuvre anyway. If unemployment goes up, more than likely the Reserve Bank will try and compensate by pushing rates down. But it's way too early yet to see any of that come through yet.
I've noticed reading your Daily Edge that credit markets are adjusting too. So there's growing talk about banks needing to pay up to issue debt. So we've got APRA watching non-financial risks more closely and spreads nudging wider.
Yeah. Again, this is one of those adjustments that the market's going to have to make when we go from free trade zones to, tariff zones. Credit spreads over the last, say, 20 years have come right in. I've said to many people, my gut feel is that the market's not pricing risk properly. And, there's so much money moving around that a lot of these spreads have come in a lot too closer to where they are because it's not pricing properly. So this correction will flow through, and if it flows through, if we get to, this trade war really digging in and becoming pretty robust or horrible, then credit spreads are definitely going to blow out. There's too much risk. If rates go up, then which is really the credit spreads blowing out, it's risk reward. If people are struggling to earn revenue and make money, well, that's companies. Companies are in that environment. If they're starting to struggle, then their debt position or their credit spread should blow out, not come in. And I think they're too skinny right across as it is.
All right, let's begin to wrap it up and leave our listeners with key takeaways for the week. So let's land this plane. So what a week. Global trade tensions are heating up. Central banks are walking a tightrope between inflation and recession, and bond markets, well, they're having a bit of an identity crisis.
Yeah, as I guess we've been saying through this, definitely it's going to be, it could be the calm before the storm, really. We're all sitting and waiting because Trump's only been in for 6 or 7 weeks. He hasn't been in long, and he's just turned the world upside down. So we've all seen it, and everyone's holding their breath and looking at it, and and can't believe the turmoil and can't believe what's going on. So that's going to come through for sure. So the world will have to reprice everything pretty much.
Yeah.
So all the bond markets, all the stock markets, all the housing markets, all going to have to reprice.
Okay, so the key message this week: stay nimble, stay informed, and remember, markets don't run on hope. They run on confidence. And when confidence is shaky, strategy matters more than ever.
Yes, definitely. In my day, it used to be fear and greed were the two things that would basically drive a market. And I think fear is starting to sneak in. So that when fear sneaks in, then everything, it's irrational. People then get, it's like a run on deposit. People just get really scared and fearful, and that's gonna start washing through as people get more information and they see the damage that's been done to companies, to margins, to governments, and how hard it's going to be for governments to pay down debt. If they don't start, cutting spending and getting their debt down now, then they're going to they'll feel it because interest rates will start drifting up if inflation becomes a problem.
Thanks, Al. Well, that's it for this week's edition of the Weekly Edge. Thank you, listeners, for listening, and as always, from all of us at Gilt Investments, stay sharp, stay steady, and we'll catch you next week.
Absolutely. Thank you very much, Richard.
Cheers, Al.
Thanks for tuning in to the Weekly Edge. At Gilt Investments, we're here to help you navigate the fixed income markets with clarity and confidence. As an Australian fixed income brokerage licensed to advise and deal in fixed income securities, our experienced team is ready to help you reach your investment objectives. We hope you enjoyed this week's Edge and that it helped keep you in the loop and ahead of the curve. Until next time, stay sharp, stay focused, and we'll see you on the next episode of the Weekly Edge.